How does someone go about building a network like that from scratch?
Good question. So my general rule is if I'm not willing to have brunch with you on a Sunday, then I don't want to work with you. I've been removed from another group because I was over pitching. Because I was a lot younger then and I was just really excited. I was like, I want to see how this thing works. So I do a few things differently. I don't charge any money. I don't make any money. I don't lose any money.
Maxwell Nee. At 33, he's built a private network of over 200 wealthy families, 60% joined by referral alone. He's the chairman of Family Office Insider, a 6-time award-winning entrepreneur, and has been featured in Forbes and the Australian Business Review.
You know, if you want to be a good investor, go lose some money. Sharing ideas, like I threw some events, ended up doing an event in Sydney and Istanbul, just where I was traveling at the time.
Yeah, that's convenient.
Managed to get a sponsor like the Singapore Stock Exchange, MA Financial, it's a publicly listed company. All of a sudden, we've done 10 events with the Singapore Stock Exchange. We're getting referrals from these families that just want to meet other people, and it just sort of blew up to 200 plus. And I joke that it's the largest unmonetized group of investors in Asia Pacific because it really is.
What's different about you that you've been able to crack this open and they're just sharing it all with you?
So I get asked this a lot, and
Maxwell, welcome to Flow Zone.
thank you for having me, Mark.
It is awesome to have you here. You're over from Singapore at the moment.
Yeah, that's correct.
And that's where you reside now, right?
Yeah. I left Oz about 10 years ago.
Yeah, wow. Well, that's the big wide world of business there in Singapore for sure. There's lots of parts of the world that actually look at Singapore for what they're doing in a lot of arenas.
Yeah.
I want to get straight into something that you've been doing incredibly well. Like you've built a network of 200 wealthy families.
Yeah.
Right? A lot of people would probably know 1, 2, or 3 of those, but to amass this network of 200, and 60% of them have kind of joined by referral. So you haven't sort of marketed your way into them or hustled your way into them. How does someone go about building a network like that from scratch?
Yeah, good question. So it started from pain, like a lot of things. So a few years ago, my brother and I are real estate developers and private credit lenders. So we build stuff and we lend money. And we had 3 projects mid-flight during COVID, and they all got stung from, we couldn't get timber, couldn't get concrete, couldn't get plumbers, just totally blew out. It meant to take 3 years. It took 8. And then at the end of COVID, I said to my brother, look, we really need to get outside our comfort zone and, look at different things, like just look at venture capital, private equity. We had no idea at that point in time. We only knew real estate. And I said, okay, how can we get some new ideas from some people, business owners, like starting from zero? So I knew 2, 3, 4 families, and I had an idea to add them into a central database, like a WhatsApp group at the time. And we just started sharing ideas. Like I threw some events, ended up doing an event in Sydney and Istanbul, just where I was traveling at the time.
Yeah, that's convenient.
And then managed to get a sponsor like the Singapore Stock Exchange, and then like another sponsor like MA Financial, it's a publicly listed company. And then all of a sudden we've done 10 events with the Singapore Stock Exchange, and we're getting referrals from these families that just want to meet other people, and it just sort of blew up to 200 plus. And I joke that it's the largest unmonetized group of network of investors in Asia Pacific because it really is, and that's sort of the thing we do differently.
Wow, that's incredible.
Yeah,
like to get Singapore Stock Exchange involved when you've come out of a pretty hard time in development, property development.
Yeah.
We'll probably touch on that in a minute. Up in Brisbane, I believe that one was.
Yeah, in Brisbane.
During COVID, then you've gone, okay, let's put a WhatsApp group together, and all of a sudden you're getting sponsored by listed entities and stock exchanges themselves. There's got to be some magic that's happened in between there.
Yeah.
Before we go into that, though, we've got a broad audience here, but it's predominantly entrepreneurial thinkers.
Yeah.
Though we've already talked about some terminology here with family office, right? Wealthy families, ultra high net worth, family offices. Can you just break down your definition of that so that our audience can sort of be with us on this?
Yeah. So the textbook definition of a family office is someone that has at least, say, $50 million worth of assets. So they might have sold a business, they might have made it in real estate, and they're typically a family entity. So it's not just one principal entrepreneur. It's usually the family working as like a team. So husband, wife, kids, husband, wife, auntie, uncle type of thing. And It's called a family office because it's designed to preserve the capital and the wealth of that family through generations. So it's designed to have governance structures and you can't just wake up one day and decide I want to give it all away. Like you create parameters for yourself about where and how you invest your money. Yeah,
That's a good unpack.
yeah.
I think people hear family offices and
It gets thrown around.
yeah, there could be a lot thrown around. And look, I've heard slightly different numbers, but that's why I wanted to hear it from you. So around 50 mil Australian would probably constitute it. And often multi-generational. It's something that I've seen a lot.
Multi-generational plan for the money. Yeah.
Okay, multi-generational plan for the money. Good one. So these kind of networks are hard to put together. A lot of these family offices are very private, very discreet about how they do things. And there's, quite a bit of complexity in their financial structures alone. So they don't always want to let everyone know about that stuff. What's different about you that you've been able to crack this open and they're just sharing it all with you?
So I get asked this a lot. And, so over the years, we've had 200 people, families join the database, and 60% have come from referral. So I've really geared it so it's like client first. So typically when people have a network of investors, they think, how could I monetize that? How can I create, basically sell this database, like sell emails and phone numbers and whatever. And from the beginning, I said I would never do that because a lot of these guys are my friends. Well, they are my friends, and I pretty much only do business with people that I consider a friend because life's just too short to not do that. And so I do a few things differently. I don't charge any money. I don't make any money. I don't lose any money. The sponsors that come in just pay specifically for like the production of an event. So food, bev, maybe a speaker or hotel rooms or whatever. But Max, as of right now, doesn't even make an admin fee type of thing. So it really is just time. And people ask, why do I do that? Well, it got to the point where I was getting, 2-3 referrals a month, sometimes a week, to meet a family that just wanted to meet others, but they wanted to get to know me first before I became like a conduit to introduce them to other people. And each one of these coffees would take 2.5 hours. I'd have to drive out, meet them, grab the coffee. And I thought, wow, like this is super valuable. I would never say no to this, but it's just taking a lot of time. So I started wrapping and bundling, hey, come and meet Max into events that I do like every few months. And then I meet 30 people at once and build my database and my relationship, my PR, my black book, 30 people at a time instead of one at a time. So it actually, by not charging any money, it actually creates efficiency for me based on how much lead flow I was getting, so to speak. Yeah.
So it sounds very noble. It sounds fairly safe for someone to get involved in.
Yeah.
What's the purpose of the collective then? If you're not making money off it that way, what is the mandate of this group?
Yeah. Well, we don't, just pitch each other, hey, look, I'm investing in my thing, I'm investing in my thing. We don't just ask each other for money. But I'm in business with, 4, 5, 6 people, and those 4, 5, 6 people really, really want to be in business with me because I've got a database of another 180, right? So it's more or less leverage of like, hey, look, here's a formalized black book of what I bring to the table if we were to do a deal together. And, I'll bring this to the table. What do you bring to the table? It's literally just that.
Okay.
Yeah. And that's worth it for me because when we do deals, we're talking equity and we're talking long-term thinking, which is what I really like and what we're building towards. So that is, to me, is worth more than, $5,000 entry fee to an event, every now and then might make, 20, 40, 50 grand, every 2 months type of thing.
Yeah.
Yeah.
Yeah. Okay. So what kind of things are you investing in together when you do go in as this group?
Yeah, good question. So one thing that's really hot right now is gold. So we invested in a gold exploration company that's acquiring exploration assets in Africa. And now we're trying to bring it over to Australia. So we're looking at assets in WA, Northern Territory, and a little bit in New Zealand. And outside of gold, we have a technology that turns waste into diesel. So it
Okay.
takes like carbon waste, so like trees, woods, grass, plants, and then burns it in low oxygen, known as pyrolysis, and then that turns into a biodiesel.
I remember there was a biodiesel when I did a stint in the mining industry when I was in engineering.
Yeah.
And I remember it's because they were using reclaimed oils from fish and chip shops.
Exactly.
And it actually smelled like fish and chips.
Yeah,
like
yeah,
when
wow.
instead of the diesel fumes, it smelled like diesel. It literally smelled like slightly burnt fish and chips.
Amazing.
So
Amazing.
I can validate there's demand for that because if the mining industry is buying it and they buy stuff in droves.
Yeah.
So who's making the decisions on what investments you go for? Is it like a collective mindset of all of these people that are like, hey, I'm going for this, you should too? Or is it like investment directors, like a traditional fund? How do you do that?
It's not a fund. So it's not a fund. So we don't invest together, deploy capital. It's more like think of it as like a mastermind.
Yeah, okay.
So we all meet up and imagine us, we sit around a table, we'll talk ideas and then say, hey, you're doing this, I'm doing that. You should meet this person, I should meet that person. And a lot of these meetings, because they happen in Singapore, everyone's deals are offshore because Singapore's quite a small market. So to be able to get an international referral is worth a lot, right? So
Definitely.
that's the real zest. Yeah.
Yeah, I like that. So putting these kind of networks together, there's a lot of things that can go wrong.
Yeah. Oh yeah.
And like I've been involved in development unit trusts and syndication there. I've had a good run in venture capital, seed capital, angel investing, business partnerships. And there's like little traits on the way through of things that were always destined to fail. And there's other things that look like that they were red hot.
Yeah.
When you've got this many people come together for almost kind of a community cause here, it's not like they have to be there.
Yeah.
What do you think's holding them together and keeping it so good? And I'll flip that to the second part of that question. Why do you think most of these things fail?
Yeah, it's a good question. So I think what makes my group attractive is the genuine intent. I've tried really hard to design something that doesn't have a conflict. Like when you have a database of people and then you say you sell entry to like a law firm to come and pitch you and you might make 20K and that's really easy money. But that's a conflict of interest, right? Because who are you in the best interest of? Are you in the best interest of the audience that's coming or the law firm that's paying you? Who's your actual client, right? It's a bit like a podcast. So if a podcast just wraps these walls of advertisements, right?
Yeah.
And then you sell out and then your listenership goes down. So I could see that could very easily happen. So I wanted to stay away from that altogether. People try to balance it, but I said, I want this to be a real flywheel where more is more. Instead of I take a bit of payment and then I need to bounce this, then bounce that. like I want it to be like the list just keeps growing at accelerated pace over and over and the referrals keep coming in faster and faster and faster, which they have. And then I just need to be a little bit more disciplined and super transparent and honest about how I monetize adjacent to the network, which is, hey, look, I'm working on this thing. Who'd like to look at it? Let's meet for coffee.
Yeah.
Yeah.
Okay.
So I've totally stayed away from selling out, so to speak, which is, I think, makes it very, very attractive.
Yeah, I agree. So like what I'm hearing there is that like by resisting the temptation of the sort of short-term gain,
Yeah.
it's giving everyone confidence and genuine reason to be there.
Yeah.
And I suppose that synergizes a lot. Some of my listeners have heard me talk about Entrepreneurs Organisation quite a bit. We've had a few guests here from YPO and EO. And that's similar in that there's a lot of hygiene around like we're there, together we grow, share ideas, share experiences, but nothing leaves the room and you're not there pitching each other. There's actually pretty hardcore laws against it, rules against it in the Constitution. You can seek permission to do business together over a certain amount, but it's just not the essence of it.
Yeah.
Yet, plenty of it does get done because
Exactly.
it's done properly and it's come from the right place.
And then it comes organically.
Yeah.
It comes in like a way that feels good rather than like a, hey, look, this guy's bothering me type of thing. Yeah.
So on the failure front, then we're thinking that if we sell out with ads, that's how you sort of turn that side of the network off.
Yeah, so they're selling out with ads. You know, there's bad eggs. You know, I've definitely had a few bad eggs we've had to remove. There's overpitching. I've been removed from another group because I was overpitching. Because I was a lot younger then, and I was just really excited. I was like, I want to see how this thing works.
What were you pitching at the time?
I can't remember. I wasn't even pitching my own thing. That was what was so silly about it. Like I was just helping out a friend, and I was like just a bit too generous with willing to help people out. You know, giving away my time everywhere, and then what that looked like on the outside was, you know, I was just like this super broker that was always brokering something. But I was just trying to understand the nuances of what works and what doesn't. You know. So yeah, I did take a calculated risk. I was like, you know, I'll push the limits and then I'll you know, reverse from there type of thing. You know, what it's really taught me is like who you work with and who you choose to associate yourself with is just, you know, it'll last 100 years. You know, like the investment of how you choose those people, you know, what makes you choose those people will last like 100 years. You know, as a ethos of a number.
Yeah.
Right? Yeah.
Well, I think that's a really great place to start from. So, because you're across so many sectors, like I've heard you're involved in whiskey and wine and, like you said, gold, like things are running hot and you've obviously got a way of assessing that. But what are you mostly working on right now? There's usually one or two big projects for people like yourself. What's happening right now?
Yeah, thank you. So I left Australia about 10 years ago, and I left and renounced my tax residency, you know, gave up my right to vote, gave up my Medicare, everything. So I'm officially a Singaporean, you know, resident type of thing. And when you're in Singapore, what you got to do really carefully, when you move to any country when that's different from your passport, what you got to do really carefully is count what days you're spending where. You know, like how many days you spend in Europe during the summer, how many days you spend in Dubai, in London, in the US. You're like between each US state, you know, if you're a McKinsey consultant and they send you to like New York and LA, you got to count those days and then report them. Yeah. Which is a massive pain in the ass. Yeah. Like it's the worst thing in the world to have to go through your passport and read the stamps. And
plus, if you get it wrong, it's fraud, right?
Yeah, if you get it wrong, it's fraud. So
that's a pretty like, you know, straight to prison for you on certain countries.
And it's such an innocent little but painful problem. So my co-founder and I, he's a tech guy, I'm the sales guy. We founded an app called Flamingo Tracker, which is available on the App Store, and it automatically counts your days for you. US states, residency, citizenship days, the days you spend in Europe in the Schengen area, because that's free travel, and the days you spend out of it. Yeah. You know, international waters, because, you know, really, really wealthy people, they actually spend X amount of days in international waters to then stay out of the Monaco, you know, day counting thing, right? Yeah. So, but if you don't evidence this, then, or if you can't evidence it, it's fraud. You can be pinged for fraud and tax evasion, that type of thing, when you just calculated the days wrong. Yeah. Right? So this app does it for you automatically. And we've had some amazing people sign up, like some English football teams.
Like Premier League?
Premier League football teams.
Wow. Who else?
Some billionaires, which we all know the name of, some celebrities as well. And we can see, obviously, we have, like, you see, you know, their geolocation and stuff, because that's what the app does. And it's just a really simple, and what really gets me excited about this app is that I've invested in a few other SaaS companies, and some of them have had churn rates, so where people uninstall the app. Yeah, well, it's super common. About 7% a month, right? Mm-hmm. Which is a lot. That's close to 100% a year. So every year you need new clients. The churn rate on this is almost zero. Wow. Yeah, because it's how many years do you pay tax? You pay tax every year. Yeah. Right? So
it's a recurring need. And I suppose it compounds its own value because you get a logbook at the end. Like, you've got to keep it for a while. Yeah. So you've kind of got this reference there.
Yeah. And then you have to, you know, when you have it, what's your audit window? Your audit window might be 10 years. Yeah. You know, so you got to have the 10 years. Yeah.
Wow. Yeah. Did you have, when you started, was that something that you thought could help, like low churn? Did you think, oh, these people are going to need this forever? Or like, what was your initial insight?
It was a dangling carrot that this could be a really low churn because it makes sense. Yeah. But to actually see it work was a different thing, you know, because it was a was an ideal scenario that this would have low churn. But it in practice it actually does.
This is a pretty diverse kind of path you've had, right?
Yeah.
Property development, which I've been involved with as well. It's it's niche, and it's got its own world of parameters around it. Like you can move around a lot in property development. You can go small resi developments, you can go to kind of mixed use, you can go to high rise, and and then you can go to hospitals and schools or childcare centers or whatever you like. But to go from that into building this network of family offices and now investing in tech, gold, SaaS.
Yeah.
What happened in between there? Where did you get all this investment education from?
But from just losing money, that's your best investment education. No, so I think I'm one of those entrepreneurs that's a real. What I enjoy is solving a problem really, really well, and it doesn't bother me what problem that is. Some people are like, I want to plant trees, like I want to build stuff, I want to do design. But I've never had that pull towards I want to, master one lane. I like having like a new Rubik's Cube every morning and then solving like a new Rubik's Cube type of thing. So I'm like a new problem, deal junkie type of entrepreneur.
I've been accused of having too many fires burning at once.
Yeah.
Has that ever been suggested to you, especially from these ultra rich people you're surrounding yourself with? There's some pretty wise people amongst those.
Yeah.
Has anyone ever tapped you on the shoulder and said, look here, son,
Yeah.
in whatever accent they're speaking?
All the time, and I went too far the other way, and then I burnt out because I said I'm just going to focus on this one thing, and that business did really well, but I hated that business by the end of it.
What was that, out of curiosity?
It was a coaching business.
Yeah,
It was a business coaching business.
Selling your time.
Yeah. Selling your time, and I was so insulated, like I was so bubbled in, and that's why like now I really love the variety and the diversity of meeting new people, like someone. The person that just makes this wire, for 20 years, or just makes this or something, right?
Yeah.
That's really interesting. So yeah, yes, focus is great, but I think you can also choose what layer in the business you focus on. So I'm more or less like a freelance investment banker. For a deal, I'll find the money and I'll find the sales. And that's what I enjoy. That's who I enjoy talking to. That's who I have coffee with. That's who I want to keep having coffee with. So I just am mastering doing that for whatever's hot right now.
Hey, if you're getting value from these conversations, the best way to support the show is to follow, subscribe, and leave a rating. It helps more people discover the podcast and allows me to keep making these episodes packed with value. Thanks so much in advance.
Yeah.
I do like that. I think what would be really good here is like we've talked thematically about this.
Yeah.
I think people get the concept of
Yeah.
how you've amassed these people around you and what you're investing in. Could you break down a typical deal, like how you would structure it?
Yeah.
You're the one out there raising the money for this great idea.
Yeah.
And there's other people kind of putting it up. You might
Yeah.
be one of those as well. You might be investing. Do you invest in the deals as well?
Yeah.
Yeah. And then there's some kind of selection process.
Yeah.
But what does it look like in your world with these people around you?
Yeah, good question. So because like I can only lean on my strengths, right? And I'm not a 20-year investment professional, VC fund, PE fund, super diligent type of guy that will read every line of DD. I'm a sales guy, so my strength is sales. So when I look at something, I look at, could I sell it myself, and could I get an LOI, an EOI? Could I sketch it on a piece of paper and show it to someone and get their agreement that if you'll buy this at this price.
Yeah.
If I can get that, then I work backwards from there. So I start with the offtake.
Could
the
you do
sales
a
offtake.
hypothetical for us on Flamingo, but use
Yeah.
different numbers if it's too confidential, but just give us an
Yeah.
idea how you would run that pitch.
Yeah. So when I first saw Flamingo, because I wasn't the original founder, I'm like the second co-founder.
You're like the Ray Kroc of McDonald's.
Exactly. Yeah. Exactly.
I don't think that's that's
me.
not a slur on you at all.
Yeah. But like some people have that engineering.
Yeah.
Like day 1, 0 type of thing.
Yeah.
But I don't. And it took me a long time to just let go of that and be like, hey, then I watched the Ray Kroc movie.
Here we are.
Here we are. Yeah. So yeah, Ray Kroc. with Flamingo, we help people track their tax days. Are you in Mykonos or wherever? Because you need to know those days when you report for tax, especially when you pay a large tax number, right? And when I first saw the app, I said, okay, that market. My initial thoughts is my gut feeling is that market seems a little bit small. Like how many high net wealth individuals need that and whatever. And then I said, who are your biggest clients right now, or who's had the biggest traction right now? And then the founder said, oh, well, we actually have this English Premier Football League. We have the celebrities. I'm like, okay, celebrities, I'll throw that in the bin. I don't know any celebrities. We said, but we also have FIFO, like McKinsey professionals that are using it. I was like, okay, McKinsey, that's a big enough market. So you look at market size first, right? So, if you got McKinsey, you get EY, you get KPMG, you get PwC, you get Accenture, you get all of those guys all the guys that actually pay full price for business class seats, basically, right? Like all those guys. So I'm like, okay, that market's getting big enough now. But what was really exciting was the English Premier, Football League, team. I said, well, how many of those are there? And how many of those are in Italy and in Spain and in whatever? So that's enough to build a, 10 million ARR business already, just in those. And those are very easy to find, obviously, right?
Yeah.
So it's about how big's the audience, and then it's who the audience is and how easy are they to find? Like, can I find them? Can I go on LinkedIn? Can I search them? So where this doesn't work is, like, for example, in personal training, because people don't put on their Instagram profile, 20 kilos overweight, so you can't search that.
Yeah.
Like it's got to be searchable. So I look for businesses where the target audience is searchable, so that I can quickly, easily validate and actually have a conversation and talk to and message and cold message and outreach. I pick up the phone and talk to them, so I can get a real litmus sense check as soon as possible.
Yeah, so it sounds to me like part of your framework is getting as close to the buying customer or the potential buying customer as you can before you put $1 into something.
I want my fingernails in the market, in the audience, and I want to really understand that customer and talk to them, and if I need to meet them at a trade sale, at a conference or whatever, I want to talk to them, look at that, wide are their eyes, what do their teeth look like? And then that helps me to just digest the market, the opportunity. Yeah.
Was there much competition for Flamingo in the first place?
There's a few, but the trick with Flamingo is that when you download the app, we don't ask you for an email or phone number or whatever, and it just starts tracking. So my technical co-founder is brilliant at building apps, and he's managed to make an app where, how there's always like a payment wall, or there's like a, here's your email, 2-factor verification, type in your phone number, get an SMS. There's none of that. It just
super
starts
low
tracking.
friction.
Zero friction. So it goes straight onto your phone and it starts counting the days. And then all of a sudden, when your 30-day, free trial is up, you're 30 days in. And then it's like, now I better sign up to an actual plan.
Because I want to keep this stuff.
Yeah, because I want to keep the data. And the data as well is stored locally. Okay. So we don't have your data.
Right.
You have your data.
Okay.
Even the App Store doesn't have your data. Yeah, so that's a very, very, contentious point, especially for billionaires and people that just don't want to have.
I think that's clever.
Don't want to have their data be seizable. It can't be seized because it's local.
Well, I think this is one of the really key things at the moment with the, we've been in the world of proper AI since 2022. We know it's been around a long time, but now that we're sort of unpacking it more, but the general world became aware of it November 2022 when ChatGPT 3.0 released. And privacy is a big thing.
Yeah.
Data integrity is a big thing.
Yeah.
And now that everyone's had a little bit of experimentation and some people are still in shock and fear, it's quite clear now that even the biggest providers of AI are going to start bringing out local models, and they will only sit on your device. And one of their kind of key things to talk about will be, I do this one little thing really, 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 really well. And if you want it to go beyond me, you're going to need another AI next to it to hand it off to.
Yeah.
But if you want to just do this one thing on your phone, we can do it.
Yeah.
And I think I'm hearing that a little bit with this app. Like the app is downloading kind of how to run it, but it's only running it just there.
Yeah.
And so all of the reasons that someone wouldn't come onto it are kind of taken away. The friction's taken away at the top of the funnel, which is the biggest impact.
Yeah.
And then the next part of friction is what would make me leave or what would scare me about this. And that's been risk reversed by keeping it local anyway.
Yeah.
So if you're pitching this to one of your 200, let's say, and you're like, look, I've got this Flamingo thing.
Yeah.
I'm looking for an investment size of X dollars on this Val.
Yeah.
How much more info do you give them about where you think it's going?
Yeah. Good question. So if you Google Sequoia pitch decks, so Sequoia's, I don't know what they are, top VC fund in the world.
Yeah, they're huge.
And they've got an 11-page pitch deck that you've got to put it in that format.
Yeah.
Unless otherwise they won't read it.
Yeah.
So that's good enough for me. So I just copy that format, and it goes, loosely title, problem, solution, vision, products, market size, defensibility, competition, financials, and then ask, $2 million, $10 million, whatever you're asking for. So I just put it in that format, and that's what everyone is used to. It's a bit of like a template. It's like left-hand drive, right-hand drive. Like, what are you used to? So you give it to people and how they're used to it. And then it's up to them. And then they'll ask all the same questions that I would ask, which is, okay, that all sounds good. These numbers sound very good, but what's attraction? What's attraction? What's attraction? What's attraction? All the really, really big, here's an interesting point. So Ashton Kutcher, the actor, he's, very funny, very likable, but he's actually a very, very good investor. And I heard him speak about, so he passed on Airbnb and he passed on Uber, and I think he passed on Facebook. And he
Must be really good at other investments.
Yeah, must be really good at other investments, right? But he, and what that has taught him is that he said, with Uber, he said, no one's going to get into a stranger's car. And everyone thinks that, right? Most people thought that no one's going to get into a stranger's car. Like, why would you get into a stranger's car? And he said that what he's learned is the guys that really, really hit it out of the park and have the outsized returns, they have a piece of data that is typically contrary to what the mass believes, and they are right.
Yeah.
You know what I mean? So what Ashton has learned to ask himself now is, but what if people were willing to get into a stranger's car? What if people were willing to put their personal information online? What if people were willing to share their house for a night for a short-term stay? Like, what if? Like, if there's a 1% chance of that, could that give a 10,000% return? And the answer was yes every time, but he didn't see that. He didn't have that lens every time.
Yeah. See, I hear that straight
Contrary
away.
data point.
And I'm contrary to that point, like in just the way I think, because I was taught first principles in engineering. Like,
exactly.
And it's basically, it's similar, but the subtle nuance is what would need to be true for all of these people to do something that seems so crazy.
Yeah.
So instead of saying no one's going to do it, except if, it's like what would need to be true for all these people to go against what they're doing right now.
Yeah.
Kind of what I'm doing with Australian real estate, in that majority of real estate in Australia is on the sell side or the owner side.
Yeah.
And I'm of the belief that we need to create a proper customer avatar for everyone that interacts with real estate, tenants and buyers in particular. Everyone in Australia that's got a roof over their head is either a tenant or a buyer at some point, and they always know a tenant or a buyer at some point.
Yeah.
Whereas owners are either selling or managing on a periodic basis, like it's event-based.
Yeah.
They're disgruntled with their property manager and I just happen to be there. Or, it's sort of like going to someone when something breaks, but you don't know when it's going to break. So you're courting all these people that probably won't end up using by percentages you anyway.
Yeah.
Whereas if you're getting closer to the customers that are doing something right now and talking to the other people, we add meaningful value to them, then we're adding more value to the owners anyway, because we've got better tenants and better buyers. We don't have to preference them. Yeah. So I think about this with like things like, to use your example, Airbnb, Uber, what was the other one? Facebook.
Yeah.
Like, let's just go with Airbnb. Like, if you actually break down how much it costs to move house, it's very expensive. Yeah. And there's a lot of people that when the interest rates get a little bit high, like they're just uncomfortable. But if you're uncomfortable for 3 years, that's a long time. It's a long time to be uncomfortable living on the edge. Yeah. So if there was a way to just make it slightly more comfortable, then there just have to be a checklist of things that would make that possible.
That's a really good angle to look at it, just like what's the pain threshold that will push them to try a new, something out of their comfort zone, right?
Yeah, well, I think you mentioned at the start. How did you learn everything? Through pain.
Yeah.
How did people buy most things? They move away from pain. Yes, towards pleasure, but more away from pain.
Yeah.
But there's this other thing in there. We must reverse the risk, because if there's a fear there that's underlying that hasn't been brought up, even if it's painful, they won't jump off the hot frying pan unless the risk is reversed, that they're not jumping straight into the fire.
Yeah.
So I like that. You've teased that out of me, but I think that there's something in there.
Yeah.
Ashton Kutcher is the guide.
Yeah. So it's just, it's data, right? So when I'm talking to people and trying to verify sales, I'm just collecting data.
Yeah.
So it's like, what is that data that is irrefutable, that is telling us this boat is turning this way, right?
Yes.
Yeah.
I wanted some data on that watch you're wearing right now. What is that?
It's a Cousteau.
It's gorgeous.
Yeah. It's a boutique. As an investor, I always try to get value in things, right? So, Rolex, Audemars Piguet, Patek, they're mature markets.
Yes.
So I try to go for the next boutique,
It's emerging.
Swiss market. So this watch, it's owned by the grandson of Frank Mueller.
Oh, right. Yes.
Yeah. So it's in like the Swiss mafia.
The funny
type of
spelling
thing.
of Frank.
Yeah.
CK.
and the designer is the Richard Mille designer, because
really?
they're friends. Yeah.
Man, I remember walking into Harrods of London when I was just getting into watches, right? I was really aspirational at the time, and Panerai and U-boats and a couple of other things. And I'm way less into them now, because I can only wear one at a time. I'd rather buy a wall full of sneakers and lend them all to my mates than watches.
Really?
That's me now.
Yeah. Nice.
But I remember walking into Harrods, and one of the things I really liked about that is that they had some of the best watches in the world there, including rare pieces, not just expensive pieces that are, available in most boutiques.
Yeah.
And I walked into the Richard Mille, and I had my tag on that was my wedding watch, and it was actually part of my honeymoon. It was 6 months later, because we waited for the European summer. And he's like, "Oh, what is that timepiece you're wearing there, sir?" in his British accent. And I'm like, "Oh, it's just a tag." And he's going, "Never say just a tag." Like
Good for him.
I thought it was good, it's like, oh, okay. And then he went on to tell me why that is, and I thought that's pretty cool, because everyone's going to be a bit intimidated. And I'm looking at a £326,000 watch. I wasn't actually looking to buy it. I was just like, what are these like in real life?
Yeah.
That's just a divergent tangent there altogether.
Yeah.
So what kind of, I probably cut you off before, what kind of upside can someone expect when they're in your family office network and they go for something like Flamingo? I mean, what do they get in at? What was the val then? What is it now? Like, what does that work out for?
Yeah, so upside depends on just risk tolerance, right? Because it's all about risk. When I got into investing as just like a, ex-professional employee at Commonwealth Bank, I thought, I want the biggest multiple projection. No. You don't want that. You want
comes with the biggest multiple of risk.
Exactly. But you don't want that. You want the highest walls that are blocking out the risk. The highest moats. The Warren Buffett, the moats. That's what you want, and that's what actually creates the multiples. Conversely, the moats create the multiples, not the big market size.
Yeah. Okay. Yeah. So typically, what are the, like, I know you're saying the risk tolerance, but what is the kind of typical? What are people looking for?
What's the number? So I made an angel investment in a company called Score App, which you may know.
I did see that. You're an advisor, or you're a chair or something of that nature.
Yeah, and it's a lead generation SaaS company, and I entered at a price, and right now, like a year and a half ago, I'd already made 8x.
Yeah.
But Angel was right at the beginning, so that's like super high risk. You got to really know the person, the founder, Daniel. I really knew him, and I was like, wow, I'm so glad that I'm I was in the inner circle to get offered this, because I can see this journey. And now I'm pretty sure that is doubled now. So I think it's a 16x by now. So if you're taking angel risk, like first money in risk, you want at least a 10x, right? Because that's the risk level. But a lot of people, like in the property space, like what's a good return in the property space, right? Because investment in tech competes against investment in Bitcoin and gold and blockchain. So it's all got to be relative. So if 10% return is good in property, then if you're taking tech risk, then you should be getting 80% return type of thing, right? Like comparatively relative to real estate.
I agree. So like I've got a similar outlook on this that I'll share, and I probably need to make another video on it actually. So I look at it like, okay, well, what's our income generation engine in the first place? And how vulnerable is that engine?
Yeah.
Like if we've got 6 cylinders pumping out very consistent income that's growing at a reasonable rate above inflation, we're comfortable, we own some assets, then you can kind of figure out how much of that you got to play with to start with, and how much actual equity you got to play with as well. And when it comes down in the pipes, I want it to go straight down into the pipe of investment first and just have the essential living money coming off the side and the play money limited off the side, because I want to have my play money off the money that the investments make. So I'm not playing with my capital.
Yeah.
But then I want to have a box. And in those boxes, like there's multiple things I've got to tick. And one of them is like, how many opportunities to exit do I have? Is this a single exit, like investing in a big property development in Brisbane before COVID?
Yeah.
If you're in the ground digging the basement and you hit some water table issues or some archaeological issues or some other geo issues like that.
Yep.
And then you start bringing the concrete up, and then the builder goes broke, and then you've got to get another builder, and you've got to maintain the warranty in the meantime, and the market perception, and then the market changes.
Yeah.
Like, it could be 8, 9, 10 years to get your money out, like you've talked about.
Yeah.
But the only real way to get it out is to sell your position to someone else, which doesn't look great when things are tanking.
Yeah.
Or to wait to the very, very, very end, whether that's a bitter end where it's all gone, or whether that's a payday. But in the meantime, what are you breathing? Are you breathing on fumes?
Yeah.
So if there's multiple exit strategies along the way, that always helps me. And it's like, what's the play? Like, do I just want to, like, I'm in a serial acquirer fund with PyLab, which is like the Constellation software model, if you're familiar with it.
Yeah.
So they basically buy niche businesses that are part of an overall group strategy, but they buy them to keep. And every dollar goes back into the fund. It's not like there's a dividend coming off it. So by having that compounding money going back in, constantly in a position to buy better, we can use a fair bit of debt instead of having to use capital all the time.
Yeah.
And eventually it just gets its own steam. And we've tracked Constellation's tracked the same kind of trajectory as Amazon over a 20 to 30 year period. And we've got one of their directors on board now. But that's a very different fund because like you're not seeing any of that for a long time. So the only way to get out is at a liquidity window.
Yeah.
And you've got to trade with someone internally or bring someone in.
Yeah.
And it wants to be a good year because it's based on a preset formula of what that position is worth at any given time. Hey, if you're getting value from these conversations, the best way to support the show is to follow, subscribe, and leave a rating. It helps more people discover the podcast and allows me to keep making these episodes packed with value. Thanks so much in advance.
Just on that, so really simply, I try to only do things that have 3 benefits, at least 3 benefits. So the first benefit might be this could pay me like an investment, as an investment maker, it could pay me like a short-term retainer. So a couple $1,000s a month, X amount of months for the length of the projects. The long-term benefit is typically equity. So I want some type of equity piece. It could be a success base, could be built in. I could have founded it, right? And the third one is usually the most fun one that should try to stick in there, but you got to make sure there's at least 3. The third one could be that I'm doing business with Harry Triggerboff.
Yeah.
And that's really cool credibility. I can use that, on my CV, so to speak, forever. Yeah. Or it could be that I'm building something that has so much fat in it that I can then sell it at a discount to friends to then sort of build goodwill.
Yeah.
So for example, we've done. I was paid a retainer to raise money for this land site, and this land site has 2 parcels. One parcel to do myself, the next parcel I could give to someone else at a discount or favorable payment terms, like a Harry Triggerboff, and then say, hey, look, Harry, I want to give this to you really favorable terms. I'm going to give it to you off market, no agents, just you and me. But next time you build a penthouse in Sydney, I want a good deal.
Yeah.
So it's like you're playing your cards short, medium, and long term.
Yeah.
So I always want to try to look at 3 benefits: short, medium, and long term benefits.
I like that. So yeah, you've got a matrix, and you're looking at each of those boxes and saying which of these does it fill.
Yeah.
Okay. So short term benefits could be like the the money that you're getting from bringing an investor to the table, whether that's a one-off sugar hit like a commission, or like an introducer fee, or it could be a retainer while you're doing the labor of raising, because a lot of people don't get it about raising. You're not just going out with a preset product that's already got product market fit. You've got to make it fit. Right.
I'm so glad you said that. It never fits, you know?
You've got to find something in there in their investment mandate that's also here. And sometimes you're actually going back to the people and it's like, you know, I know I've got this great 11-page pitch deck, but I actually need to fundamentally changing what you're offering here because they don't want that thing. Have you able to do that much? And what's an example?
like you know, I've got some startups that I've worked on where we had like, you know, pitch deck version 182.
That's bloody measured 182 times cut
182.
once.
I'm
gonna call it Blink 182.
Exactly. And you know, sometimes it's not always like a retainer because, you know, sometimes taking short-term cash is the worst thing that you could do because that will attract you to certain things. Like typically, if people are willing to pay a lot up front, there might be something wrong. You know, there might be a smell.
There's a bit of a desperado feel. It also
desperado.
makes you look a little bit like that sometimes. Like, I really
Exactly.
need the money off this. I'm not so connected to the long-term cause.
Yeah, exactly. So, you know, some people, like, there's one startup that I've made introductions for, which is a health insurance startup, and they're so awesome. So basically, they can help you save private health insurance in Singapore, Malaysia, and in Hong Kong, private medical health insurance with an arbitrage of about 30%. Yeah, cost saving arbitrage of about 30%.
Wow, that's pretty significant for an industry like that. It's super squeezed.
Yeah.
Like since all the comparisons have been out, it's kind of been
The margin's 8%.
yeah.
You know, so they're 4 times the industry margin, right? And I wanted to help them, because the founders are amazing. So, you know, got to always be good people. You know, my general rule is if I'm not willing to have brunch with you on a Sunday, then I don't want to work with you.
Yeah.
You know, it's got to be, there's got to be like bro vibes, or there's got to be, you know, bro connection, or that type of thing, so to speak. And bro's unisex, by the way, so don't ping me for being, for being sexist.
We could be like one of those really old literatures where like they call everyone a man, but they just mean human.
Yeah, human. Yeah, exactly. And you know, so for them, I help them because they have a really great network. And I wanted to build short-term equity, relationship equity in helping them. Also because I wanted to create a role for myself in that business long-term, because I know that business is going to go all the way. That business will be acquired for $1 billion minimum, you know, once they get the sales up. And they're already getting the sales up.
Yeah.
So the train's already in the right, you know, on the right track, heading in the right direction, and it's just picking up speed, you know? So I threw my hat in, you know, waived any retainer, said, look, if I do bring some real dollars, then yeah, you know, let's talk about a paid role because I think I've earned it, type of thing. But then I wanted the long-term credibility of whenever I call you with something, that you'll take me seriously.
Yeah. I want you to take a look at this, not just say, send it over.
Yeah, send it over. I'd love to take a look at it. You know, you'll take me seriously. So that, like the weight of that, like what is that worth? Yeah. Right? Yeah.
I like that lens that you're looking through. It's almost like a kind of horizon system.
Yeah. It's very, you know, spit in your hand, shake type of, you know, like how I imagine they do business in the old industrial age, you know, in the US, you know,
Rockefeller era.
Right? Like they didn't have forecasts or data, or like they just had two guys. It's like, if you do this, I'll do that. If I do this, you'll do that. Okay, cool, let's do it. If we do this, we'll both win. If not, then we'll both lose. And let's do it.
And if not, you'll be floating in Manhattan.
Exactly. And there was that as well, right? Yeah.
So you've mentioned something a couple of times here. It sort of relates to the bro vibes and the brunch on Sunday. I like that one. We'll have brunch with them on Sunday because, like, I must admit, I look back at my failures in business partnerships. There's been two things that really, really stand out to me. The number one is a values misalignment. Like, and I get cringe over it. Like, I get cringe over me partnering with those people, you know, like when they're just like, yeah, let's go, bro, to the moon. Like, you know, and it's just all money. And they're like, all the text messages are like cash flying and people throwing around Wolf of Wall Street. I'm like, fuck, like I know, like I'm out there kind of character. I know I'm full of energy. I know I'm upbeat.
Yeah.
You know, I know I used to party a lot.
Yeah,
but I don't want to be compared to the Wolf of Wall Street.
Yeah,
well, I certainly don't want to be like proud of the way that they did what they did, right? So if we're in that same basket, like, yeah, let's stitch people up, I'm like, fuck, I'm out of here. But like that instinct on reflection was so loud.
Yeah.
But yet still, I wanted to see the best in them and thought, they're just keen. You know, they're just keen. They respect me. They're not going to like mess with our clients, mess with our business. And of course they did all of it. Like all of these people.
If you're doing it here, you're doing it there.
Yeah.
Right? You're doing it inside, you're doing it outside.
How you do one thing's how you do everything. Often people say. It's not like it's a proverb that like is entirely accurate, but it still is a good signal. The other one I would say is just it's got to do with like they're moving fast at times when it should be more considered and moving slow when they should be getting on with it. You know, and I just think it's a bit of an indicator. Like, you know, when you're getting to a really important framework, paperwork, like what's the legal structure going to be? You know, what's the terms of this going to be? What's the ins and outs of the shareholders agreement? Like, we need to talk about this stuff. We've got other companies, there's other interests. I've got fiduciary obligations, there's multiple directors. And they're just like, oh, bro, it'll be sweet, man. Like, I've never had any issues.
You know, so I've totally been naive and a victim of this, right, to myself. And look, cowboy energy is good at times.
At
times, it's the worst thing. You know.
How do you split it though? How do you know now?
It's just scar tissue. Like it's just, you know, if you want to be a good investor, go lose some money.
Yeah.
Right. If you want to be a good business person, go get in business with the wrong person. You know. I think business and investment and everything, because it's all dealing with people fundamentally. It's very similar to dating. You know, so typically if you put a dating lens, like if you apply your dating standards, unless you got to work on that as well. But let's say,
I'm pretty happy with them.
But let's say you got to apply your dating standards into business. All of a sudden everything becomes really obvious. It's like I would never tolerate this. Like if this person lived with me and they were, you know, throwing their socks everywhere, like and keeping the house dirty and they come to a party, they get drunk at my Christmas party and sort of make me feel a little bit embarrassed and stuff. Like I would never tolerate that, my dating life, right? Because you instinctively know that this is a life partner. This is a 100-year lockup. Right. And I think if you apply that same lens, and I want to write a book about this, I just haven't found the angle yet.
Well, we can have the transcript all fish, man. This is the seed.
So you know, business investment, it's just like dating. You know, the standards. You know, some parts of it is all about status. You know, who you should walk away with, who you should invest in more, like how much they impact your life, how much time you invest into them. It's all there.
So even though I've just told you a bit about my scar tissue and you've got it as well, and here we are, you know, flashing each other's scars, like there's really strong advice that comes through from lots of advisors. You know, either careful or don't do business with friends. But yet it seems to be like you said before, life's too short not to. So what kind of definition of friend are we talking here? Is this someone you grew up with at school? Is this someone you know from a sports club? Or did they become friends during a business deal? How do you look at that?
Yeah, so the word friends doesn't mean... I used to think that it meant long-term friends, you know? So I would give my long-term friends money, and that's like the worst thing because, you know, they're not... It's a bit like... You don't want to take. You want to take business advice from like a Warren Buffett. You don't want to take it from your uncle just because he's your uncle. Right. And I've done that plenty of times. Right. So, by friend, I just mean someone that I've got time for, that I enjoy spending time with, irrespective. I don't need to get paid to spend time with them. You know, like if you're really, really just spending time with this person for the money, then I think something at some point will break. There'll be a crack in the vase at some point.
I think that's really fair. I think that's really fair to look at. And even add another Stoic lens to that, if you've ever read any Stoic philosophy. I read a bit of Marcus Aurelius, and Ryan Holiday's translations are incredible. There is one that's, I think it was said by Epictetus, and it's like the vase is already broken. And he talks about this beautiful vase he's holding on to, but he's looking at the vase, it's already broken. It's got a shelf life. So I'm grateful for it while it's here, but at some point that vase is going to break. And when it does, he's not going to be surprised.
Yeah.
And I think I look at some of those deals that we've gotten into, and it's like, it's kind of, oh yeah, it's just a means to an end. I'll just do this. It's going to be harmless. And look, there probably are examples. There's probably plenty of examples where you can be a bit arm's length. You can bring the capital to the table. You're making no promises to those that matter around you. Yeah. You're like, look, it's a pretty good thing. The fundamentals are good. Would I have brunch with this person on Sunday for the rest of my life? No, but I can handle it for 3, 6, 9 months.
Yeah.
You know, but like we're still looking at that vase like it's already broken.
Yeah.
And even with friendships, some of those that have crossed their heart, hope to die, never leave you, bro, you know, loyal to the death, whatever. I still have learned that I have to still take that with a grain of salt because like a marriage, like a relationship, you're still kind of renewing your vows every day, every week, every month.
Yeah.
You're not doing it formally in front of everyone, but you're still making that commitment to still be here and still show up. And if you're not doing that, then you can kind of start feeling it energetically.
Yeah.
Have you got any wisdom to part with here? Because this has gone in true flow zone style, man. We've been in the zone. We didn't even need to do a rapid fire today. What's a couple of key pillars you'd like to leave with our entrepreneurial community here of things that have come from your lessons? You're still very young from what it looks like anyway. Can I ask how old you are now?
Yeah, I'm just turned 33,
Yeah, all right. 30 plus GST.
Yeah.
Well, you probably don't have to pay GST. What are your little gems?
Yeah, so what I've learned is I used to be really generous with my time. And I still am, but I'm strategically generous with my time, right? So where you spend your time, you know, your time's the ultimate currency, and that sounds very cheesy, but what I mean is, if you're going to do a deal, it's got to have a short, medium, long-term benefit. You know, benefits 1, 2, and 3. If it doesn't have at least 1, 2, and 3, then you'll never reach the top of the pyramid of the guys you aspire to. Because, like, I spend so much time with billionaires and 9-figure people, 10, 8-figure people, type of thing, and the way that they look at things is like 3D chess. You know, like they're always playing 3D chess and they're always thinking longer term. They're thinking like, you know, what time will this, if there's a 2% chance that this will cause problems in my marriage, I would not do it because that would then cause problems here and here and here. And if I'm talking about at dinner time, like the weight is just too heavy to, and I'm not saying like try to aim for perfection, but I mean the cost benefit ratio is always like almost zero bottoms downside. Like it's how they structure things. So don't think about big numbers. Think about how can you suck out the oxygen so that there is no flame, so there's no fire, there's no risk. How do you suck the oxygen out of the risk? Yeah.
That's brilliant.
Yeah.
That's probably a key gem, really, to leave with us. I don't need 10 off you. So with your community that you've got, like the family office community, familyofficeinsider.co, I'm pretty sure it is.
Yep.
This is somewhere where all of our listeners could go and take a look. Yep. It's invite only though, is that right? Or how does it work?
It's invite only or referral.
Okay.
So, you know, come and chat to me. You know, I'm on LinkedIn, Maxwell Nee. Yeah. I'm addicted to LinkedIn. So
I'm just diving. I'm getting a bit more serious on LinkedIn just recently. Just so many of my guests are on there, and like I'm kind of in that space. So it's just like, okay, I've had enough fun on the other platforms, but I'm actually hanging out there a bit more now too.
Yeah.
Okay, so I'll check you out on there to get involved or to see what's possible.
Yeah, see what's possible.
And what about Flamingo Tracker?
Yeah, so Flamingo. I think the easiest, we have a few URLs, flamingo.tax is probably the main one. And
you're still taking on money for that, by the way?
We are. So we have a very, very small round because we're almost cash flow positive.
Yeah, wow.
To be honest, yeah.
That's for that kind of product.
Yeah.
What is it per month, roughly?
It's between £7 to £20 per month.
Yeah,
so
right.
it's a very small number.
But well, for the people using it is. But still, if you think about organisations deploying that across all of Ernst & Young or all of McKinsey's, and then you look at like almost 0% attrition, churn rate, that is crazy.
Yeah.
Good on you, man. You've picked a winner.
I I believe so.
Well, that's part of the reason why we've got you on. We love our subject matter experts. I really am grateful that you've made the stop over here on this 42-degree day in Melbourne with your beautiful wife, partner, spouse. I don't know if I got the terminology right.
Yeah, wife. Yeah.
Wife, yes, thank you. As well, who's been making sure that we stay in check over here as well. Bit of body language here and there.
Yeah.
But yeah, you're back to Singapore after this, and everyone knows they can find you on LinkedIn. So Maxwell Nee, thank you very much for coming on Flow Zone.
Thanks, mate. Appreciate it.